Hi, I'm Dhesingu, quant researcher and trader. Here, let's talk about Copula. So, in pairs trading point of view, we might have an knowledge about the correlation and the co-integration methods. Okay, so now, but it has certain disadvantages, like these two methods may give answer to the questions like, do two assets together move on average, and for long run equilibrium? That's it. They fail. First of all, they fail in their non-linear relationships, and second one, and they fail in the tail dependencies. Suppose there is a two stocks naming X and Y. So we cannot say that we cannot say that Y is mx plus c as simply. And second one, in the tile dependencies, like see, during the period of crash and during the period of high bump up, they both accelerate together, which they don't have the mean reverting uh, opportunities like in the middle. So we are focusing on the mean reverting opportunities to trade on the pairs and to capture the arbitrage advantage. So for this we are using the terminology called Copula, which is a function, joint distribution function of the two marginals made by the distribution function of two stocks X and Y and their log returns. Basically they are log returns, because log returns are the stationary one. So now when we go to the copula, so the meaning of the copula is joined together. Okay, so nothing but the joint PDF between the multiple random variables. Okay, now we using copula to obtain the joint distribution function. Okay, so we are using marginals of the log returns of the pairs. Okay, so this is the pair 1 and this is pair 2. So we are finding some function joint distribution function h of y, which is nothing but copula, to find out the relationship between the two stocks. So generally we'll right now neglect the exact mathematics behind the copula making. Okay, so we'll leave this, but the major point here we need to check about is the copula function. Okay, mm, C of u comma u1, sorry, u1 comma u2 is equals to p of u1 u2, which is nothing but the probability cumulative probability distribution function of the marginal 1 and the marginal 2. Okay, so now we'll go with the understanding of this. Okay, so we found out the Copula distribution functions. Now we have to see the conditional probability of the distribution functions, which is nothing but p of u1 for the given u2 is equals to the partial derivative of the Copula function with respect to the second variable dependency, sorry, our variable, and similarly for the conditional probability of stock 2. Okay, so now, and the Copula distribution function small c of u1 and u2 is nothing but the second derivative of the respective distributions. Okay, now initially I showed you a graph, right? This graph. So this Copula density function depicts this. So when you have such a so for example, if you take u1 is equals to 0.7 and u2 is equals to 0.4, in this case if you find some value between the grounded level, okay, you have an opportunity of mean reverting. Okay, so that means I'll give an example. If the Copula density is something below 10, or we can say below 5 or below 1, and the probability P of conditional probability P of u1 with respect to u2 is equals to 0.9, and P of u2 with respect to u1 is equals to 0.9 and 0.1, just think. But so this will make you uh, 0.9 0.1. This will make you an opportunity that it is already been highly overpriced, so it might get mean reverter. So you need to short this stock and long this stock. Okay, this is the basic concept. We can move on. Okay, now if you deep dive into the Copula understanding, okay, now we can move with the dependencies. So we are seeing the measure of the dependencies, which is nothing but the Kendall's correlation and the Spearman correlation. Presently we are using Kendall's correlation because it's just purely based on the rankings of the values instead of the strength of the values or the values. Okay, so now when you go with the Kendall's correlation, and next one is Archimedean Copula. Archimedean Copula is in the form a Copula that can be written in the form of phi inverse of phi of u plus phi of v. Okay, so phi is not the pseudo inverse. Pseudo inverse is nothing but the that definition has been given in this notes. So this is an example where phi of theta of t is nothing but 1 minus t power theta. Okay, so here the Copula is in the form of this one, which is given as this one. Okay, so the why we are taking the Kendall's correlation? See, the Kendall's correlation coefficient become easy in the form of Archimedean's Copula. Okay, so this been taken as this one, just but 1 plus 4 of integration 1 to 1 and phi of u and phi inverse of u du. Okay, so this simplifies our overall calculations, and we end up with a different type of Copula: Clayton, Frank, Gumbel, and Gaussian. So, and N14. These are the types of Copula. Stick their Copula value and their phi value, theta value, which belongs to, and also their Kendall's tau value. So here we can but make different Copula under the same tile dependencies, okay, sorry, same distributions which have different tile dependencies. You can find certain copula with lower tile dependency like this, and or you can find certain copula with higher tile dependencies like this, okay. So it is based on your selection of copula and your distribution, okay. So you have a question may arise, so like copula is nothing but a type of distribution function you you are getting from your distributions of the two stocks, okay. Now you may ask, how can I evaluate my strength of the copula? So which copula should I select or pick on, okay. So that can come from the func function is called maximum likelihood function, so which is nothing but the log likelihood of the uh, distribution, okay. So for maximum likelihood estimator, right, so which is nothing but the argmax of theta, okay. So which from the copula distribution function, okay, or any other function. So let us take an example of the Gaussian distribution function which have the maximum estimator of the mean, sample mean mu hat is equals to summation of the xi divided by n, which is nothing but the mean of the Gaussian distribution, which shows the unbiased form of the distribution, okay. So now we are going with the same max MLE to find out the which is the highly capable copula for your, or highly selective copula for your uh, distributions of the stocks or the values, okay. Now in the theta, so we have certain parameter L max, okay, which shows the maximum likelihood estimator. So from that L max we already told, so you know theta is nothing but which belongs to this one. So from the Kendall stove we'll get the theta. Suppose for the Clayton tau is equals to theta by theta plus 2, so this is equals to 2 tau by 1 minus tau, okay. So here we find the theta. So from the theta we'll find the maximum likelihood estimator. So from there we'll have the archaic information criteria and the Bayesian information criteria. These are two of the evaluation metrics to find out which copula is better for your distribution. So we, when AIC and BIC is very low compared to the next copula, we can say which in which copula these two are low, we have to select those copulas, okay. From my point of view, I have been taken two instruments, Nifty and Bank Nifty, okay. So and then I found out student T copula distributed or fit well according to their distributions, okay. So now there are two cases. One is based on their conditional probability, another one is cumulative misprice index, okay. Let's leave this right now, we'll focus on more on the conditional probability, okay. So already I told you, so when you find the uh, or grounded level of this copula instead of their tile dependencies, because tile dependencies will make you to trending, or we can say more uh, pair moment, and also the accelerations of both stocks we cannot estimate, okay. So we cannot put our uh, stocks in the overexposure such that we don't have the any hedging positions from the uh, trading point of view. So when you go with the mean reverting one, we are already hedged with the one instrument. So one is Nifty, we hedge Nifty with Bank Nifty. So we already in the safe position, and we are just purely making money based on the arbitrage. Okay. So now when you go with the page trading, so we already showed you either U1 or U2 or U2 or U1. So you make a threshold which has some 0.9 or 0.8, sorry, 0.9, 0.8. You need to focus shorting here and long here, whatever may be the stock. So now when you have a mean reverting opportunities like this, when a particular stock, especially Nifty, when you short here, it may go down, and at the same time when you see the hmm, Bank Nifty, it was in this position, so it may go up, and you have to square off in this position, this one. So this condition may give you entry point, but you need to find your exit point based on your stocks and their movement and their observations. Okay, so exit points thought difficult, and we have to mm, identify our exit point. So that's one of the cases. So so I have done this with the Nifty and Bank Nifty as their as the pairs. So I have taken with those respective entry point and exit points. I made my own exit point, and I found out as values of this one, which is nothing but uh, okay. So see the cases. Here we are having an alpha here, and this is just from the Nifty point of view. I didn't put the Bank Nifty values. I just came out with the Nifty point of view, and we found out that it has been an alpha here, which shows us an uptrend, sorry, or could be curve, but we have huge drawdown in this places, and moreover we are finding very less points. Average is 5 to 6 points we capture here. So our alpha is not that much strength more strong enough, and moreover we have to find a better entry and exits more than this, because this market is not actually a more we can say stable market in terms of the entry and exit what we expect. Okay, so this is the sample case which I shown here. So I think you have learned more about these basics of the Copula trading. So next I have find more way to enter into next level from this probability distribution point of view. I'm sure you got an idea how to trade here. So thank you so much. Bye.